Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing partner with Budd Wealth Management. We have developed and refined our client life process over the last 20 years to work with families that aspire to a work optional lifestyle. We help to put all the pieces of the financial puzzle together for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content and invitations to future events like this one on a regular basis. Also visit us at buddwealth.com. This session today is being recorded and you'll all receive a link to the recording from this session in a follow-up email. Today's class is an LPL Research Outlook for 2025. Outlook 2025, Pragmatic Optimism. This presentation is not meant to try to predict the future. It's a way of approaching a new year, reviewing the conditions that are present and looking at how these conditions have previously affected the markets. A sound way to approach each year is by updating your financial plan, making sure that your goals, cash flow needs, whether in the present or in the future, are included in your planning. I hope you find this content of interest and the perspective shared today helpful. The economy, consumer spending slowing, but policy tailwinds are expected. In 2024, business owners said that they were waiting to ramp up capital expenditures until after the election. The market seems ripe for a resurgence of CapEx in 2025. Other than consumer spending, the other main components of the private sector are net exports, change in inventories, and business fixed investment, which is the broadest category of CapEx. Further, the demand for power and communication structures are on the rise, equipment spending is slated to increase, and research and development is making up more of the U.S. economy. All of this suggests upside to business spending in 2025. Demographics will likely be a tailwind to growth in the coming years. Millennials are just about to enter the peak spending and earning years. Because of the amount of households who refinanced mortgage debt in 2021, and because of the rise in real disposable income from a tight labor market, we should see some continued strength in consumer spending. By the time we approach 2030, about 75% of the labor force will be millennials. Outside of the raw economic forces giving the economy a demographic tailwind, the greatest intergenerational wealth transfer is about to start, and millennials and those younger will be the beneficiaries, further strengthening the consumer in their peak spending years. Higher income households are the ones driving consumer spending, and incidentally, the ones least impacted by pandemic-induced rises in rents. They are also the ones least impacted by tariffs, according to research surrounding the Trump-Biden tariffs. So the key point here is investors need to watch what the upper-income consumers are doing, where they are shopping, and how they are managing expenses, etc., because they will be a leading indicator for the rest of consumer metrics. Inflation is decelerating, but not nearly as fast as the Fed would like. Barring any supply shocks and extreme tariff policies, we don't expect inflation to re-accelerate, but the path to 2% is slow and arduous. Complicating things is the stickiness of owner's equivalent rent, OER, as imputed cost and not an actual cost affecting people's pocketbooks. Other sticky components like medical care services and insurance have kept inflation rates elevated. The slow and sluggish path to the Fed's target of 2% means the Fed will likely take a cut and pause cadence in 2025 with a total of 4 25 basis point cuts throughout the year. Stocks, a measured approach for 2025. The bull market has entered its third year, having celebrated its second anniversary on October 12, 2024. The S&P 500 is up nearly 70% since the move began, with a booming year 2 of plus 32% following a below average but respectable year 1 of 21%. A surprisingly resilient economy, unwavering trends in technology, moderating inflation, the start of the Fed's rate-cutting cycle, and a strong earnings recovery after the earnings recession ended in 2023 have driven much of the gains. History suggests that this bull market has a good chance to celebrate its third anniversary. In the absence of a recession, the odds that a 2-year-old bull market gets to 3 are solid. For bull markets that get through year 3, the average gain for the S&P 500 is 5.2%, with 6 positive years out of 8. The bulls that didn't make it through year 3 were ended by recessions, an overly aggressive Fed, or in the case of 1987, excessive speculation. We believe the chances of another positive year in 2025 without the start of a bear market decline are quite good, but history tells us to expect modest gains. Longer term, the history of bull markets offers cause for optimism. Since 1950, excluding the current period, S&P 500 bull markets have averaged 61 months and have produced average cumulative return gains of 167%. In other words, while volatility along the way is to be expected, this bull market could still have legs. After one of the longest pauses in history, the Fed cut interest rates in September and November. Now, the question is, how much support additional cuts may provide for stocks in the year ahead? Based on the last 9 major rate hiking cycles since the 1970s, the S&P 500 has generated relatively modest gain average returns of 5.5% during the 12 months following the initial cut of a cycle. Taking out the recession-plagued outliers of 2001, 2007, and 2020, the median gain has been 10.8%. Prospects for solid returns in 2025 are favorable if the economy avoids recession. That does not, however, mean we should not expect volatility. In fact, even in non-recession periods of 1984, 1989, 1995, the S&P 500 experienced pullbacks of between 5 and 10% along the way to double-digit 12-month returns after the initial Fed cut. The earnings growth picture is much improved from a year ago. In the past year, stocks went from an earnings recession and widespread recession fears to a now widely held consensus view that the U.S. economy would continue to grow steadily, though perhaps at a slower pace than recent trends, and that corporate profits would grow double digits. In response to improved corporate profit trends, LPL Research is maintaining its S&P 500 earnings per share forecast for 2025 at $260, in line with the long-term average earnings growth rate near 10%. For 2026, LPL Research is initiating a 2026 S&P 500 EPS forecast of $275, 6% above 2025. Broadly, corporate America will get some help from AI investments and related productivity gains. The Magnificent Seven are expected to grow earnings by an average of 17% in 2025. Banks and energy companies should benefit from deregulation in Washington, D.C. However, potentially slower economic growth, the potential for rising borrowing costs, and tariffs are among reasons to expect modest earnings gains in 2026. Cuts to corporate taxes also offer potential upside. With positive sentiment at record extremes by some measures, risks may be growing for a near-term correction. In fact, U.S. households are as confident as they have ever been that stocks will move higher in the year ahead. Though some sentiment readings, such as those taken from the options market, are more subdued, any signs of exuberance call for discipline. Bonds, a golden age for income investors. Current market pricing suggests that the Fed will take the Fed funds rate back to around 3.5 to 3.75% in 2025. If markets are right and the U.S. Treasury yield curve eventually reflects its historical uptrend sloping shape, that likely means that the 10-year yield should remain around current levels. The spread between the Fed funds rate and the 10-year Treasury yield has averaged around 1.1% in non-recession periods, meaning that the 10-year yield on average has been higher than the Fed funds rate by around 1.1%, albeit with a large range when not in recession. So, until economic data starts to show signs of a sustained slowdown, the 10-year could fluctuate between 4 and 4.5% to start 2025. But if the economy does show signs of slowing, the Fed could cut rates more than what is priced in, which would mean that the 10-year Treasury yield could get back into the 3.75 to 4.25 range at the end of the year, which is our expectation in LPL Research. The Treasury term premium is the additional compensation required by investors who buy longer-term Treasury securities. The term premium, which is unobservable and hence must be approximated, considers a variety of factors including Treasury supply and demand dynamics, foreign central bank expectations, and the possibility of future inflationary pressures. And after years of a negative term premium, investors are just now getting compensated for owning longer-term maturity Treasury securities. But that additional compensation is still below longer-term averages. So how does this affect fixed income or bond investors? A positive term premium could keep longer-term interest rates elevated, perhaps reducing the diversification benefits of core bonds. Regarding the former, though, while monetary policy expectations will continue to be the dominant driver of interest rate changes, Fed rate cuts may not have the desired effect, and longer-term interest rates may not fall as much as they would have without a positive term premium like we've seen recently. In terms of the latter, while we still believe Treasury securities will be a safe haven choice in the case of a broad macro equity market sell-off, they may not be the best defensive option for garden variety equity market sell-offs. While economic growth will remain the driver of interest rates, a secondary risk to rate remains the amount of Treasury debt needed to fill federal budget deficits that are expected to stay elevated. Per the Congressional Budget Office, the U.S. government is expected to run sizable deficits over the next decade to the tune of 5 to 7% of gross domestic product each year. And to fill those deficits, the Treasury Department will need to issue trillions more in Treasury securities. But complicating the math, for the Treasury Department, it will also need to roll over more than $6 trillion in Treasury securities set to mature in 2025. Thus, the Treasury will need to find investors for some $8 trillion of Treasury debt over the next 12 months. But despite the mountain of debt and growing interest payments, the U.S. government is not at risk of a financial collapse, nor are there concerns as such. As long as Treasuries are considered risk-free securities, there will always be buyers for Treasuries. Full stop. But with a Republican sweep of Congress and the White House, the deficit will likely remain broadly unchanged at elevated levels in the coming years, or perhaps even grow given what we know so far about Trump policy proposals. And with the amount of Treasury supply, interest rates may need to stay higher than otherwise expected given economic data alone. Geopolitics. Markets have navigated successfully a series of high-risk scenarios throughout history. Even significant market downturns caused by recessions, exogenous shocks, and liquidity meltdowns have ultimately led to stronger, more resilient markets with more attractive valuations. Currencies. The dollar continues to reign across global currency markets. Solid economic growth, especially compared to other developed countries, has been a major driver of strength and stability in the greenback. Developing uncertainty over the trajectory of inflation, expectations for gradual easing from the Fed, and positive interest rate differentials have further supported the dollar. President Trump's proposed tariffs could elevate currency market volatility and stoke inflation fear, putting additional upward pressure on the dollar. Based on this backdrop, LPL Research believes the dollar will be well supported in 2025. We expect limited downside risk, while meaningful upside could be capped by the gravitational pull of Fed easing. From a technical perspective, the U.S. dollar index has been contained within a range over the last 2 years, marked by support near 100 and resistance around 107. And while recent upward momentum could push the dollar into the upper end of the range, a breakout appears unlikely given the Fed's rate-cutting cycle will likely continue throughout 2025. In summary, for the outlook for 2025, the economy, consumer slowing, but policy tailwinds are expected. Stocks, a measured approach to 2025. LPL Research believes the chances of another positive year in 2025 without the start of a bear market decline are quite good, but history tells us to expect modest gains. And bonds, a golden age for income investors. A couple of resources that I think you'll find handy. You'll receive a link to our resources page that you can access and download the full report to read at your leisure. There will also be a link to schedule a follow-up meeting and ask any further questions you might have about today's presentation. For those of you that are not clients that would like to receive more information about our services, you can indicate that with an email. And you can email me at jbud@budwealth.com. There are some important disclosures that'll be following this, but again, I want to thank you for attending today, and I hope that you found this information helpful and insightful. Have a great rest of the day.